Hello and welcome to Oil Market Insight. We are here in December 2011 at the OPEC 160th conference. So you're all very welcome and thank you for joining us. Now, of course, we're looking at the state of the oil market and looking at the uncertainties there have been in this year and the issues that the ministers are going to have to deal with. And joining me to discuss this is Bill Farren-Price. He's the Chief Executive of Petroleum Policy Intelligence. Alex Schindler, he is the Middle East Bureau Chief with Energy Intelligence Group. And Jason Schenker, the President of Prestige Economics. So thank you all, gentlemen, for joining us, and we're looking forward to sharing your knowledge and your insights into what's going on in the oil markets. Jason, I'd like to talk to you and just start off with looking at maybe the macro picture. There's an awful lot of issues going on at the moment. There has been throughout the year, and we've still even managed to keep a pretty solid price up there in terms of around $100 a barrel. But give us a feel for what are the big issues that the ministers have to contend with as they close the year.
Sure. The first thing is really the deceleration of demand in growth that we're seeing globally in a number of different markets. If we look at the Eurozone, you're seeing a slowing of growth. If you look at China, you're seeing a slowing of growth. And there's also a risk that you could see slower growth everywhere. I think that's first and foremost the most important thing that they're going to look at. There are a number of other supply and demand dynamics they're going to be looking at as well on the production side, and the fact that demand is expected to remain relatively flat. Even if you see global growth slowing down, but those are the things that we're going to be thinking about, that they're going to be talking about, that we're going to look for in a communique tomorrow.
And when you look at the monthly oil market report, OPEC's monthly oil market report just came out today, and they're also looking at reviewing and revising the figures in terms of growth. They had predicted 3.9% GDP for 2011. They've reduced that to 3.6. But now for 2012, they're saying they're still expecting GDP for 3.6. I mean, there's still growth out there.
There is growth. It's slower. And the 3.6, that revision down, we're going to see revisions down from all the different organizations that forecast these numbers. And I think if you were to say, where's the risk to oil right now? The risk is clearly to the downside. Yes, there's geopolitical risk. The geopolitical risk is always out there looming in the background. But at the end of the day, these markets come down not to rumors and whispers and concerns about risk. It comes down to physical supply and demand. And as we've just heard from Bill, the supply's coming online from Iraq. It's coming online more from Libya. So you've got supply going up while global growth is easing. You're still going to see some oil demand growth next year. That's simply because it's a significant growth multiplier. But if you said, where's the risk to price? If supply goes up and demand doesn't go up as much as supply, prices go down. And that's something the members have got to be thinking about. And the other thing they need to be thinking about that's really important that we haven't even addressed yet is the currency risk and the volatility that currencies play in the pricing as a pricing mechanism. The dollar is the pricing mechanism of oil. This is a whole other thing with the Eurozone and the debt situation. What could happen with the dollar? If you see the dollar strengthening in the beginning of next year as Europe gets weaker, right, it could push oil down. So you've got the dollar potentially pushing it down. You've got supply potentially outstripping demand, potentially pushing it down. And these are things the members have got to be concerned about. None of it's a guarantee, but it is a risk, and that's the direction of it. And
that currency risk, it's come off the headlines, really. There was a time, I mean, last year, and everybody was looking at it and the impact where the dollar is. Why do you think it's come off the headlines? Do you want to come in here, though, on this issue? Do, please.
One thing about America, I think that we do see in the States an improving economy. It's getting better, but it's a very gradual process. I think the trajectory is good. I'm much less worried about a U.S. recession. I think Europe's in a much worse position. I think China's seen some slowing growth, and the fact that both the European Central Bank and China...
But surely in America, I mean, this flat, sluggish economy, I mean, going nowhere, that's not a good indicator out there.
Well, it's growing. It's just growing at 1.5% to 2% a year, and the unemployment rate's basically remaining flat unless people stop looking for work, and then it goes down more. It's not a show that sells tickets. It's not an interesting story. It's not a strong story. It's one of muddling along. And unfortunately, that's going to be the story for the global economy in 2012. It's going to be growth, but it's not going to be significant, impressive, overwhelming, and I think that's the most important thing I see. I just think the U.S. is less exposed to recession. Yeah, I think that's right. I think that the story of decelerating growth, it's a second derivative issue. It's not that growth is becoming negative.
And you put great emphasis on that, exactly.
Yeah, it's not that growth is negative. It's just going to go up at a slower pace. But I think Bill's got a great point here, which is China cut their reserve ratio. The European Central Bank is cutting rates at a time when both of those institutions are seeing inflation rates that are above their target. Wait a minute. Why are they cutting rates? The financial markets are fat and happy about this. They're cutting rates. But why are they willing to cut when inflation is above their target? And I think that makes me nervous that we could see some bad data coming through.
What's the damage that could happen because of that?
Well, I think it's downside risk to prices. And I'm very concerned that the nuance that it's a decelerating growth, not a falling growth, might be lost on the broader public, who might go, oh my gosh, we're returning to another global recession, instead of, well, growth is going to be 2.5% instead of 4% globally. And I think that nuanced story might be missed, and so you have a risk of a short-term move lower. I think the other thing we haven't talked about, and I think the guys probably are very in tune to, is also what Bill had talked about, which is the demand. You're seeing in industrial markets, you're seeing demand declines along some product lines, especially for gasoline in the U.S. It's been a big drop. But in middle distillates, you're seeing a big boost in demand as a multiplier of growth. And I'd be very curious to hear what their thoughts are in terms of that outlook, because I think we can talk about oil all day, but at the end of the day, the consumers buy product, and I think there are concerns around those.
Now, I know we're looking at that price staying up there above 100, but we're always looking to in terms of investments and what needed here. Sustained high price, I think everybody agrees, no matter who it is, producers, consumers, saying that nobody really wants that. But the investment in the industry needs a relatively high price, doesn't it, in terms of what they can do? Well,
I think that's true, and I think if you look at any of the alternatives, they're so much wildly more expensive than crude oil and product. They're still unattractive. And the really potentially unsettling thing we think about prices, in 2012, this inventory deficit we've just talked about, I think that some of the Libyan and Iraqi crude could go to refill some of that inventory deficit we've seen. But as we go into 2013, if we look a year in the future, so we have a year of somewhat sluggish growth globally, and then you have more growth with oil demand growth across that period, any of that extra supply we will have had from Iraq or Libya, that may have been used to fill inventories in the meantime. But by the time we hit 2013, oil demand growth is still going up, and you're not going to have another Libya rebuild and resupply to the market. You're not going to have another Iraqi boom onto the market. So the question is, where are you going to get all those extra supplies in 2013 and beyond? So while we see WTI prices between $95 and $100 and Brent prices between $100 and $105, and we can talk about Brent and WTI if you guys want to, in 2012, in 2013, there's a lot more upside risk, because that spare capacity, it's just going to get swallowed up by a glowing global market.
I'll give you the closing word.
Yeah, no, I think Bill's right, and I also think Alex is right. For the European situation, I think eventually it will get solved. The euro, a lot of people forget how difficult it was to bring that to fruition, and that it took 2 years for it to go from electronics to paper money. But at the end of the day...
So you say it's here to stay?
Yeah, it is here to stay, and the euro is, in my estimation, it's Germany's ugly baby. And it might grow up to be beautiful, but right now it's ugly. And with every ugly baby, you gotta love it, and you can't bring it back. And so the euro is really here to stay. And if we look, though, at when is that solved, that uncertainty adds further downside risk to oil prices in the short term. But in the longer run, it's really the question of, are we investing in more oil development and production in our upstream in the longer run? Because that's really, as soon as we get past the European crisis, that's really the biggest situation we need to worry about.
Thank you so much. So there you have it, the big issues in terms of what the oil ministers and indeed the oil industry has to be looking at as we close off 2011, a very uncertain year, a very busy year for the industry, but we're closing this off with prices still up there just above $100 a barrel. That's been it for Oil Market Insight here in Vienna at the 160th OPEC conference. So I want to thank our panel here, Jason Schenker, Schenker, thank you so much. Alex Schindler, thanks for being with us. And Bill Farron-Price, thank you all for being here. And thank you for watching.